Most people look at the stock market and see a fortune-telling machine. The goal, they assume, is to predict the future perfectly, so you can make a lot of money as quickly as possible. But the reality is much harsher. The vast majority of aspiring day traders fail because it only takes one highly emotional, poorly planned day to wipe out an entire account. This happens when beginners adopt a casino mentality. They take all their available capital and dump it into a single trade, hoping to strike it rich on one lucky guess. Professionals operate completely differently. They focus entirely on survival first and profits second. Professional trading relies on mathematically engineering exactly how you lose safely. The first step in engineering a safe loss is setting a strict speed limit. In trading, this is called position sizing, deciding the exact amount of your total account you are willing to put on the line for a single trade. Think of your capital like a large pitcher of water. If you pour all that water into one massive cup, a single slip means you lose everything. Instead, you divide that water into 10 smaller cups. If one tips over, the rest remains safe. This chart displays how that strategy works with real money, breaking down equity risk at different account sizes. For a $5,000 account, restricting yourself to risking 1% per trade locks your maximum loss at $50. This creates a rigid psychological safety net. With tiny fixed positions, you could lose 10 trades in a row and still have 90% of your capital intact. You experience zero heavy emotions, and you survive to trade another day. But keeping your position small is only half the equation. Before you ever enter a trade, you have to define your emergency exit. Looking at this stock chart, we see how an emergency exit is mapped out. This is your stop loss, a rigid line drawn below your entry point based on market structure. It automatically pulls you out, removing fear from your exit strategy. Without a locked-in position size and a hard stop loss, you are flying blind. You leave your capital exposed to unpredictable, unlimited damage. Once you know exactly how much you can safely lose, you can calculate what makes a trade worth taking. This is risk versus reward, the planned calculation of how much capital you lose if you are wrong compared to how much you gain if you are right. These bar graphs illustrate the golden beginner rule. For every single dollar you place in the red risk zone, your target must be to make at least $2 or $3 in the green reward zone. When you lock in those ratios, you arrive at a mathematical paradox mapped out on this win rate cheat sheet. By maintaining strict risk-to-reward balances, a professional can actually be wrong the majority of the time and still make money. Look at the exact math here. If you use a 1-to-3 risk-reward ratio, you can have a 30% win rate, losing 70% of your trades, yet you still end up in the green. Professional trading is simply a math equation. You do not need to predict the future perfectly. You just need to ensure your planned wins mathematically eclipse your controlled losses. Because human confidence and emotions fluctuate wildly day to day, these mathematical boundaries must be written down as unbreakable capital preservation rules. These are strict survival protocols. For example, a rule might dictate that you must step away from the screen after 3 consecutive losses in a single day, or that you actively reduce your trade size during a losing streak. These rules are designed specifically to protect you from the ultimate account-destroying amateur trap, revenge trading. That is the deeply emotional urge to risk larger and larger amounts of capital just to win back what you just lost. You have to follow a single North Star principle. Every dollar you save today equals the opportunity to take a highly profitable trade tomorrow. To survive, you lock in your variables. Your position size controls the volume of your emotions. Your stop loss caps the structural damage to your account. And your risk-to-reward ratio ensures the entire game remains mathematically winnable over time. Success in the markets requires the disciplined, daily practice of not losing money stupidly.